not broken, right? So at this point of time, I mean, I want this session to be like if whenever there's a question, if you guys can so that I could also get a sense of what feel about each problems. So if you can, let her, yeah, what do you think with credit? Maybe we can spend about 20 minutes just capturing your comments. Sure. I guess. Okay. So I guess anyway, I'll move ahead. I mean, this is in a later vein. So Charles Dickens once said. So thanks, Ajay. So you're talking about payback period and what's the amount that is being dispersed. So there are certainly pertinent issues. And just to point out the central problem. So I like this quote by Charles Dickens, which is quite old, right? And so he says credit is a system in which a person who can't pay gets another person who can't pay to guarantee that he can pay, right? So that's a central problem with risk, right? Just to see how it pertains to today's world, at least I have an example from a decade ago, right? So you replace another person by asset of questionable value, right? Which was the underlying housing assets that were there. So that is what happened during the 2008 subprime market crisis. So this is very relevant even in today's world. Um, More on a later vein. So to actually demonstrate what I want to talk about, I picked up a couple of issues. So I would like to demonstrate that by this video that's being that is from a feature called The Founder. I'll just play this and then we can discuss. So there is a problem with the audio, but anyway, I'll be explaining it in subsequently. I think the volume is not low. So just to explain, right? I know the voice was not clear. So basically, he's Mr. Ray Kroc, who expanded McDonald's all over US and now all over the world. So he was the pioneer of the franchisee model that they followed. So basically, so he's having a conversation with the banker, wherein he is asking for a business expansion loan. But he is not being granted an additional limit because he doesn't have assets backing the capital. So he has availed a home equity loan, which is a second mortgage that people can take out on their existing property based on what share that do they hold at that given point of time. And similarly, we see loan against properties to be the most popular loans for small and medium businesses as well as individuals in the country. I mean, before we go deeper into what the problem is, I mean, if you can just voice out your opinions on why we should care about this problem. Why is this a problem that is worth to be solved? That would be great. Sure. I think I'll take it forward. So, I mean, it's the sheer size of the problem, right? So, according to SME Finance Forum, the overall MSME financing gap is about $5 trillion, which is 1.3 times the current level of funding. And in order to sort of, split hairs on this, so most of it is from emerging economies like India, China, and Sub-Saharan Africa, and other countries in Southeast Asia, where a bulk of MSMEs exist and who are excluded from the formal financial system. So if you look at the impact of MSMEs itself, right? So they at least in India, they contribute to about 30% of the GDP. They contribute 45% to the overall exports, and I mean the number that is purported in India is about $1 trillion. And if you look at the debt to GDP ratio, it's about 60% in India, right? So taking that analogy, if you were to say 1 trillion, how much of contribution to the GDP it would have, it would be about $1.6 trillion, right, to the top line. So that is a significant amount. And so if you have to follow top-down approach, right, so that increase in GDP would, eventually trickle down to cash in the poor, and people who are struggling to migrate in the social strata, and hence elevating poverty and so on. And from a bottom-up approach, if you look at MSMEs, there are about 63 million MSMEs, right? Out of which 96% are micro, right? So that means to say their revenues are less than 1 crore, and of which 80%, which is a staggering number, are less than 10 lakh in the overall turnover, right? So this actually indicates to a phenomenon that is akin to a poverty trap, which I would like to call as a micro enterprise trap, right? So they don't have enough capital to fund expansion, and so they don't have enough assets to back the credit. So it's sort of a vicious cycle that they're stuck in. And if we solve this problem, so we would be helping quite a lot of enterprises. So I mean, what is Mr. Raycroft's problem, right? So if we talk about uh, the video, so the banker is asking for assets, right? So he's asking for more collateral. So the predominant reliance on secured facilities and securities such as property is becoming a major constraint in expanding access to. And on the unsecured, lack of credit history. So this makes MSMEs and individuals who are new to credit informationally opaque. So it becomes increasingly relevant to leverage alternative data to underwrite and assess these entities. So I would like to call this segment as the have-nots. So this is one spectrum problem. So we'll unravel this and move to the other segment as well. So how do we solve Mr. Raycroft's problem, right? So, I mean, if we were to, I mean, I would like to reframe this as asset-based lending versus cash flow-based lending. right? So when we are talking about traditional lending products, so if a small business owner were to walk into a bank or an NBFC, even today, what is asked for is, does he have any securities to back uh, the facility that he wants to avail? Nothing on the business growth, the potential, and cash flows that are being generated. But of course, nowadays, due to availability of data, we will be covering a few models as well. This is being solved because now we have payment infrastructures which move cash in a completely digital way, and hence leaving footprints that can be traced for underwriting. And
Sandeep,
there are, yeah,
one thing I would like to add, you said how
sure,
we can solve his problem. So I
sure.
work for an NBFC. So what we did there was, I mean, assets, of course, the people did not have. So we also resorted to group-based lending. Like, the entire group has to pay some X number of X rupees as installments every time. So that also helped, at least in villages, right? Where I mean, there is a big group culture. So, what is your take on that?
Sure. I think so. What you are alluding to is a traditional MFI model
Yeah,
where they have
MFI.
joint liability groups, and so here the risk is actually tied to aversion to social stigma.
Yeah.
Certainly, I mean, this is a predominant way most MFIs work, and there are a few models that are making this. I mean, this would require champions or volunteers who are locally based, and giving them digital tools to sort of administer dispersals and collections. So that's a predominant model, but the cash flow based model is primarily what I'm talking about is uh, there are a lot of digital platforms, right? So digital native platforms there are, which would be covering subsequently. There are B2B commerce platforms. There are apps that consumers and partner small businesses use on the other side to transact. And here, as opposed to earlier, bookkeeping, which was physical books, everything, all transactions, invoices, and financials are in a digital domain. So that can be easily leveraged. And this gives a real-time view, period-based underwriting and assessment and review. This gives a real-time view, not only to control um, the process in which loans are underwritten, but also to control end user funds, because uh, we can ride on modern payment methods to authorize, deauthorize certain payments, and making sure that the loan that is undertaken is used for the right purpose and not for frivolous purchases and so on. Moving ahead, so I would like to label this as an e-commerce moment in credit, right? So in order to understand, let us first see what e-commerce did to retail. So this is a slide from McKinsey, which basically portrays how retail itself has changed from during the last century, right? So uh, in 1900s, it was local stores, colloquially called as mom and pop outlets, where there was limited choice of products, mostly basics. There was personalized attention, but it couldn't scale, and the catchment area was limited. But jump to the future, right? Present and future. I mean, uh, future is already here, but unevenly distributed. So both exist in the current world, right? So if you look at the present and future, so there it's a more of a long tail products, personalized to each customer, and it's technology assisted. There's app based digital flows to access products, discover price, and there can be targeted marketing as well. So I mean, painting the same analogy in credit, right? So on the same dimensions. Earlier it was branch-based banking. Now it's app-based banking, and choice was again limited to basic products like loan against property, or home loans or equipment-backed loans, term loans, overdue facilities, and so on, which had rigid credit policies saying that okay, you had to have so many years of vintage, you have to have minimum level of revenue, EBITDA, profitability, and so on. Especially when firms are in the investment phase. So this becomes highly restrictive, and they have to resort to other forms of financing. And given the unsophisticated nature of promoters, they increasingly have to rely on non-formal sectors where they have to pay huge interest rates. But now because we have a lot of data, we can personalize loans, and we can create a long tail product portfolio with flexible tenure and repayment options. Because each business is different. Unlike salaried employees, there's a monthly salary and so on. But if you look at businesses, they have seasonality depending on the sector. They are cyclical, counter-cyclical. So it becomes very imperative to tailor loan products just to ensure that you maintain the portfolio quality, and also have optimal provisions to protect liquidity in your system. And in customer experience, there were physical visits that were mandatory, and you had to stand in queues to deposit, to withdraw, and to avail payment products such as demand drafts and so on. But in current world, it's technology assisted, it's on demand, it's 24/7. You can access all the services over the app. You can make real-time transfers anytime in the day. And in terms of market access, since it was hyper local, you had to rely on bank branches, and that's one of the challenge where financial inclusion is becoming a challenge, because um, in spite of public sector banks having branches in rural areas, uh, you can't have the same footprint as you do in urban areas. So that's another reason for exclusion. But with digital, and you can access the entire uh, uh, set of consumers who use smartphones, and there is no need for an investment in physical infrastructure. So this is what I mean by an e-commerce moment in credit. But of course, it's applicable to banking and other financial services in general as well. Let us look at a few models that are trying to solve the aforementioned problem. So there are two broad models, right? So one is alternative finance. So as the term suggests, it is alternative to existing banking systems. So it can be either fintech companies who are raising their own capital, either through private markets, capital markets, or through banking system itself, and lending, uh, or other type of models wherein they just help in scoring by leveraging alternative data, and banks themselves leverage these services to lend. So looking at a few models, I mean, I would like to first point out that Ant Financial, which is the largest fintech in the credit sector. So to explain, I would like to bring your attention to a traditional model in banking called three from 6%. This was a bank and far more other uh, uh, transactions would solve for it. So he created which is basically a startup that was started to fund these transactions between buyers and sellers on Alibaba. And he introduced another model called 310, so which basically means that assess in 3 minutes. So he looks at historical transactions and repayment behaviors, and now it is extended to other phone data, etc. But basically assess in 3 minutes and pay in 1 minute with zero human touch. So this is called as and financial model of banking. So the entity that started off as a small startup has grown to a 150 billion entity in itself, and it has itself spun off other alternative subsidiaries like Alipay, Yobov, and Bureau, which are into payments, investments, and Zima Credit, which is a bureau with its own credit scoring. So this is a example of another model called embedded finance, wherein financial services are getting embedded into non-financial platforms like Alibaba, right? So I'll be covering a few examples specifically with respect to that model later. So looking at a few other models, TALA is an example wherein they offer microcredit loans ranging from $10 to $500. They are short-term loans. Underwriting is primarily based on Android device data and behavioral data. So when they talk about Android device data, they have an app that gets installed, and the app scans your calling behavior, messages. They derive insights based on who you call. Do you call the same set of people frequently? How long are your calls? And to some extent, the content of your messages as well. And the and other the device that you use, and so on, right? And underwriting and behavioral data primarily pertains to a psychometric questionnaire that they administer to basically assess how conscientious you are in terms of repaying the loan. So that based on this, they impute both ability and the willingness to pay, and so that is how they are able to lend by managing risk. So other model is so there's nothing new with invoice financing, but there are new players. Credex is one. So here to generate capital to lend. So the innovation is primarily in how they raise capital. So investors, it welcomes retail investors like you and me to go onto the platform, register yourself, and make quick returns on investments, right? So since you actually purchase an invoice, which can tenure can range from 30 days, and can from 10 and depending on which sector. So and a quick way for small and medium businesses. So the other model is buy now pay later. So there are a lot of examples. Two popular examples are Klarna from US and Money in India. So wherein mainly targeted at millennials who want certain kind of lifestyle and are open to credit. So they are again taking a view of future cash flows because they are young and they would eventually pay back, and these are relatively short term and an alternative to credit card, right? So for credit card, you need a credit score, and it takes time to build that history. So Money sort of and Klarna alternative data. So the other model I was talking about is where we can use to lift your credit, right? Score to enhance or build a credit history. eCredible is a firm, and it partners with TransUnion and other bureaus, and they provide a lift in your credit score. Based on your retail behavior, and there's a faster way to build a credit history and improve your credit score as opposed to the traditional way, wherein it would take him months to actually improve the score. So moving on, embedded finance is another model wherein, as described earlier, finance is offered as an auxiliary service on top of a non-financial service that's already being offered. So some of the examples here are B2B commerce platforms like Udaan, Off Business, Solve. Udaan deals with B2B supply chain, product discovery, fulfillment, and price discovery. Mainly catering to tier 3 retailers who can source products from the cities without having to actually make several trips to buy merchandise. So they deal with groceries, electronics, and apparel mainly. Off Business is a vertical focused NBFC as well as a B2B commerce platform. So they primarily raw materials. All is another example that again deals with apparel and a few other sectors. So here, I mean, uh, it's one business model reinforcing the other. So all three of them, at least Udaan and Off Business, have their own NBFCs. They get money off lending as well as lending reinforcing the transactions, wherein a few people who didn't have capital, stayed away from transacting would now transact with the additional stimulus, and hence growing the platform. So the other example is so they have rich data on partner restaurants, the customer rating, feedback, the volume of business that they do, based on which they can derive insight to underwrite them. So they work with partner restaurants to provide them working capital financing to finance the purchase of raw materials. So Quickbooks is one of the earliest fintechs, so to speak. So they are a predominant small and medium business as well as self-employed accounting platform. So what's better than having a real-time view? Right? So they have access to every ledger. They know your every receivable. They know yeah, each and every payables that you have. They know your balance sheet position and the business year to date on the books, even though it's not published anywhere externally. And they also have access to bank, help, etc. So all of this data can be leveraged to what books capital does, and, based on the financial position and data on their books, they lend to their customers as well. So the other model is point of sale financing. Wherein, this is an example of Pine Labs, where they go much advanced, right? So to businesses who have a POS machine by Pine Labs. So disposals take place within 2 or 3 days, and flexible repayment option, right? So depending on the margin, fixed percent of repayment. So basically, what happens? Paid advance to to invest in their business. Um, Payment basically happens on each on the POS machine. So in this example here, 85% goes towards repaying of. There are other government initiatives, which so TREDS is one example, which stands for Trade Receivables and Exchange Receivables Discounting System. There are 3 such platforms. So one is Exchange of India Limited, M1 Exchange, and TREDS. So what happens on these platforms is So I have a video so to explain this. Just let me know in case you're not able to hear. Sorry. Okay, I guess there's a challenge in sound.
Should I share the screen? I don't know. I mean, because I'll just make you the host for 1 second.
Sure.
Is it playing now? I've made you the host. Can you try once now, please? So I think, Sandeep, there's a problem. It's not about who
Okay.
is the host. It's maybe, I don't know, Zoom is not really allowing the
I'm
video
sharing.
audio. Yeah, I can hear now. Some in bits and pieces.
Large corporate clients. Mr. Batra just landed a huge consignment and is working round the clock. However, huge order means huge payments processes. Mr. Batra reaches out to financial institutions, only to realize that the process to take a business loan too was equally time-consuming. Tons of paperwork made the process slow and painful. But it was the unrealistically high interest rates that made the option unviable. And thus, every day thousands of business owners like Mr. Batra face the vicious circle of stuck cash flows, delayed payments, missed deadlines, reduced productivity, and unsatisfied customers. Introducing Mind Online National Exchange, India's online trade receivables discounting exchange. We have digitally transformed the vendor payment ecosystem and the way MSMEs generate working capital. M1 Exchange brings buyers, suppliers, helping suppliers generate working capital finance, invoice discounting over a transparent bidding mechanism and without any recourse or collaterals. M1 enables easy financing, digital onboarding, and faster turnaround time. Put an invoice on the platform and get it approved by the buyer. The invoice is who bid against the approved invoice. You get to choose and accept the bid that suits your needs. That's it. Money gets transferred to your bank account the next day. No need to run around carrying hefty document files to get the funds released. What really makes M1 Exchange effective is the win-win situation that gets created for not just the suppliers, but also the buyers and the financiers. The buyers can now take extended credit periods and reduce the use of capital in the business. Their books look healthier and debt-free. Financiers enjoy PSL benefits, recurring business at minimal acquisition and paperwork cost. This financial benefit gets passed on to you in form of collateral exchange or
I think um, research exchange. There is a blockchain mechanism to
Sandeep,
not getting
1 second. Can you please make me the host now? There are some people waiting. So because you
sure.
will be busy with the presentation.
Sure. Sure.
Thanks.
Is that okay?
Yeah.
Sure. Okay. So in addition to TREDS, I think I was also talking about GEM there. So GEM basically stands for Government E-Marketplace. So government has also come up with a platform wherein they want to streamline and bring in flavor of e-commerce to government procurements. And when such procurements happen digitally, so there's a mechanism for small and medium businesses who are bidding to actually finance. So those are this is text to but then so actually who uh, on um, uh, monetization and then by investors. Credit loans, but example models that are emerging. So we were uh, in section, so that's
Yeah. The answer will be yeah, but we want. It's not my job. Back and pay for.
Saying
Not going to comment. I will not allow you to make any sort of judgments based on my comments.
Is of a fugitive of the law, Mr. Malik.
They need a scapegoat.
so I think so that painted a picture. So why should we care about this problem? On one end of the problem, we were talking about people who don't have access to credit. Large corporates and conglomerates have access to credit, and they sort of don't behave as uh, uh, expected. And why should we care about this problem? So we are talking about loan frauds and on the frauds, right? So
Yeah.
there's been a in 182% year over year. So the overall size is like 64,000 crores in FY19 and about 1.82 lakh in FY20. And 98% of them are loan frauds, right? So which are basically frauds on advances taken by banks. And these are followed by a minuscule percentage of off-balance sheet as well as other frauds such as forex and so on. And another mind-boggling data point is it takes about 24 months to actually detect between the occurrence and when the banks find out. And especially in the case of large frauds where the amounts involved are greater than 100 crore, it takes about more than 5 years. And hence, basically we can say that large frauds are much well hidden, given the wherewithal that they have, and much difficult to unravel. So if we hear those comments by the reporters in the video, so basically what they're talking about is hiding personal and company assets from the bank and laundering money via group companies. right? So predominantly all large frauds have one or the other flavor of similar signatures. But the problem really here is that that banks didn't have the data. They had the data. Only thing is it was well hidden. So it's more needed so much. Um, Banks are fire hose. Uh, you know uh, which have a very tiny footprint uh, among several other documents that are presented. So actually, I mean, how do we solve? So there are some fundamental shifts that are happening on these three areas, right? Technology, data, and so at each of these dimensions in detail. On technology side, so these are a few areas in are happening and which hold the key to unravel such frauds. With cloud and the recent developments such as serverless, computing power is democratized. So there's large server farms on a pay-as-you-go basis, utility services, and on the other hand, we have RPA tools which automate manual tasks. So which would have taken a long time for banks to figure out in a much shorter time frame, because action of gathering the data, multiple data points to identify signatures can be automated. Uh, so the 63 months, we can expect that to reduce to a few months, if not weeks. And mobile, so we have increased. Of course, this is more from a consumer, not from and AML. We have the data in digital format, and we to extract the data points and automatically AML can be deployed to actually detect patterns that are not based on rule-based systems, right? So one way is to follow rule-based methodology, wherein based on the knowledge that is there in the field, you sort of look for certain signatures. But especially in the case where large frauds and especially hidden in several layers, it becomes imperative follow such advanced methods which can detect even minute and multiple, so structured and unstructured. NLG prime thing that is to derive examples here. The government has data public, so we can access all court cases, and there is several digital portals. But the right case, what and also the sentiment that is carried in each news article, it is possible to go about and read every is reported. So NLP and NLU can be used in order to perform analysis and derive approach risk is manually. Lever wherein we have native platform generating data at a rapid percent generated data. data is
So,
being
Sandeep, we have a question from Ritesh. What exactly has changed in the credit risk, environment or landscape? We already had algorithms to predict credit risk default even earlier. So, what is it that has changed in your view?
so initially way risk was assessed was primarily based on traditional data sources, right? So especially if you have to look at business credit, it is looking at your balance sheet, having a view on the sector, the outlook on the sector itself. And say, for example, and the are not uh, quite stringent. So you get your books audited from uh, but even there, I mean, so what uh, submit are open to evaluation. So, I mean, especially the veracity that is reported, uh, and secondly, most of it was reliance on. So even now, most of these statements are submitted as scanned statements, even if they are shared. So that way, end-to-end digital right. So if we have to look at inclusion processing applications at scale, um, let's expect turnaround time of a few days or weeks rather than 1 month to get assessed. So banks have to use manual effort, right? So to converting non-digitized data into digital formats and comparing spreads, uh, the standard credit, and doing this without a digital footprint actually uh, because they are not able to deploy dynamic assessment algorithms, right? So if you have data on all borrowers in a digital format and you observe them over a period of time, you can actually develop a model that classifies good and bad borrowers. And you know agency a lot of and processing loans.
So, what I
Companies.
understand, yeah, I'm sorry. Hello?
Yeah, good. Yeah, sure.
Yeah, so just to sum it up, what I understand is, I mean, even though the same thing was happening before, but it is happening at a wider scale, more data is being captured, the turnaround time is lesser and more sophisticated tools are being used, right? For
Yeah, that is
credit
correct.
risk.
Yeah, correct. So where data is reliable,
Hmm.
and since data is available from several sources, you can actually develop models
Hmm.
and you can come up with personalized products, personalized repayment rather than sticking to rigid credit policies.
Yeah, got it.
Processing it digitally is low cost, and hence, especially if you're looking at small ticket size loans, the unit economics very.
So basically, the model is getting refined because uh, currently you can handle because I'm like couple of decades back we were supporting the US bank where we were doing they had a fraud management system also. Every day the fraud analytics in and people there are those executives who manually go through that chunk of report from the mainframe every day based on certain business rules. I mean those were refined, but now I think probably larger amount of data and then the model refining is much more. That is what I understand from you,
Right.
right?
Yeah.
And also, Yeah, correct, Ritesh. So as you mentioned, right? So this was still reactive, right? So of course there were fraud management systems. We could look at the transactions and then figure out after post facto of the event happening.
Hmm.
No, no, even
Nowadays,
no, it wasn't just reactive. Even in mainframes model, there were proactive. Like they had, I remember there were some business rules. If you had some transaction like 49,999 4 5 times, up in a suspect list, which
okay,
which those specialized people will look into, and they have like 15-20 years of analyzing these reports, so they can predict okay, this doesn't look. And that used to be a daily process. Every day the mainframe would run and the report will come out at 7 o'clock or so, and they will this was for a top 10 US bank which we are supporting. And that was a critical. If that job doesn't run, I mean, I had to drive sometimes even at 2 o'clock in the night in US if that job because we have case. And I mean, refined school getting refined uh, much. I mean, waiting for the next release in a year or 6 months.
yeah.
Thanks. Yeah.
I would just like to add there. So even statistics, right? The whole analytics as a whole. I mean, it has always been there, but now we see that more and more people are using it, and there are better computers, better processing powers. So yeah, because analytics itself has changed, more data can be captured, real time. So yes, credit risk industry has also changed.
Yeah, sure, yeah. So I mean, taking time into account, I'll quickly sift through the rest of the article, and maybe we can have a few questions later. So the third lever is basically the regulatory push. So data itself is being made public. All government sources are being made publicly accessible independent portals. Things like court cases, financial statements of firms, information from capital markets, mandatory, etc., are available. So not in a CMS API format out there. The PSD2, a precursor to the open banking movement in Europe, and similar initiative, which is called NBFC-AA. So they connect providers, which can be your bank accounts, insurance providers, and so on, investment, brokerage accounts, and so on. And to gather all data about your financial behavior that can be used for any risk analysis. It can be for pricing or pricing risk that you take. The third approach is the regulatory sandbox, is again used by independent regulators. So India itself has RBI is pushing for it, IRDA, etc. They have their own independent regulatory sandboxes. The intent here is opening up the entire market, test it out in a sandbox, which basically a subset of the market, to actually see the impact on the end users, and whether the model, instead of changing the regulation to accommodate new models on the entire market. So this actually gives an experimental new models and startups to try out new business models. So the traditional approaches that can be repurposed to finance, which was used in some form or the other, it can be used for credit itself. Say something like Benford's law, which is more than like can be applied to financial statement, invoice, statement, and whenever there's a doctoring that can be, of course, this methods with other models. So working with data itself, since we are talking about the so data can be gathered from multiple methods. It can be manual, not very different. What's been happening, especially bank statements, customer protective and upload model is created government sources where APIs are not available, and where systems are already digital, we can either use file transfer or API connects to connect to the systems. The data sources itself, right? So both for SME lending or any sort of business lending are from highly structured data such as accounting information and so on, to semi-structured such as court cases, judgments, and so on, and unstructured like news media articles, social media sentiment, customer feedback, and so on. And I mean, so now as well as data sorts data. So engineering market is significantly reduced by such models. So this is the model for the models itself. For so here it is a linear process. It's more iterative, tweaked on a regular, and based on the portfolio performance over a period of time. And this can be done at scale because of more powerful technology and the data that is generated at a higher velocity in today's models. Months to do a long understand how the models perform, happen even on a day-to-day basis if required. So I mean, we have the data and the tools, but have we really solved the problem? So what we are missing out? I mean, we have data, we have tools. I think there is more power to us while evaluating this. Are we forgetting something?
So I don't know. Only data, is that enough?
Right. So I'll play a short video. The title says it all.
I've browsed 8 sites for divorce attorneys today.
I browsed 8 sites today.
My login for everything is Pauline@paulinefoo.com.
Love working with you.
Me too.
Red heart emoji.
Pink heart emoji.
Yellow heart emoji.
Blue heart emoji.
I hate Lee though.
Puke emoji.
Puke emoji.
Reading an article titled 10 Ways to Keep Sweaty Hands from Holding You Back.
My home is in 1,000 feet.
50, 151, 152, and back down to 150.
On March 15th at 9:16 a.m., I purchased pregnancy tests.
The number on my credit card is 0237 0725 0211.
So basically, what we're talking about is when data is being made universal, and when there are new constructs to share personal data through consent mechanisms. it becomes very important to protect the data as well, just to ensure that the data for the intended is being used in the right way and ethically by the in line with the fiduciary responsibility, as well as ensuring that it doesn't inadvertently land in the hands of someone who's not supposed to have it. So two regulations, one GDPR in the EU and back home by the government of India, which is DEPA, which is still being ratified. This regulation, good to see governments working on both sides. We have PSD2 and GDPR in the Europe, and in India we have NBFC as well as DEPA. So both are equally important, especially when we are making it is to ensure production of this data. So in closing, the bigger picture is, in credit, there are two sides of the coin. On one, where we are trying oasis in a desert. The second problem is, water everywhere. Data is things are hidden. There is of information. And in both areas, technology, data come handy, and also regulatory actions such as open banking as well as protection are helping it become a reality. So that's it from my side. If there are any specific questions, we can take that.
So I think it was a great session. There were so many interactive videos. I really found them awesome, and I'm sure it's the same with our other participants too. And we learned a lot about the different alternative credit techniques that are available, and also what are the challenges in front of us in using data analytics for in the credit world, in this new data driven world. So thanks, Sandeep, for all your insights. If anybody has any questions, they can please ask. I think, Sandeep, they asked the questions in the middle of the session. So okay. Is there anything else that you would like to say on a concluding note?
I think thanks a lot for attending. So taking time out on a Saturday. So I hope this was informational.
It was very informational. The slides were really awesome, and the whole thing was very good. I really learned a lot. Yeah, so somebody is asking, could you please recommend any course or books for people who are not really from this background to, understand it more in a more maybe lucid way?
So I can, all of the data that's shown here is from public domain. So there are some good white papers, the Omidyar Network, World Bank, and so on. And there are some third-party and technology as well as data providers. I can share links to those collaterals.
Sure, that would be great. Yeah, we'll publish that on our YouTube channel. So I'll just take that from you, and anybody who wants, they can access it from our channel.
Question,
or
please.
They can also directly contact you if you are interested. Okay, then you can give your email ID also.
Right. Sorry. Yeah. So this was a thanks slide.
Yeah.
Regional rural bank models or processes we can agriculture, priority, retail, and MSMEs. MSMEs here told so many things. Recently, we adopted service provided by Watts Loan to verify KYC documents. That we are finding it very useful to cross-check the KYC documents of our customers.
Sure.
With regard to lending, we are yet to start. What suggestion you can give us?
Right. So I think depending on the end customers, right, the targets track. So we'll have the constitution, whether they're or businesses. So individuals primarily it will be consent-based process. Bank statements and statements and so on. If it is a business, then we'll have to look at the usual suspects, the GST, again IT returns, bank statements again, and if it is a company, then they may have to make disclosures to the registrar as well. So depending on the target segment, we'll have to first identify the data sources and identify the prominent mode of extraction of this data from end consumers. So if it is going to be submitted statements, whether we'll need tools like OCR, etc., to extract the data from these statements and process, or are they okay just sharing their consent so that we can pull directly from the source, which will be a much easier option. And it also enables end-to-end digital, right? So it can get integrated right within your onboarding flow. While filling the application itself, consent can be gathered and data can be pulled. And then we'll have to look at the product itself, right? So the financial product that you have, depending on the policy, and configure the assessment model. And once that is done, depending on the incoming data, recommendations can be given within minutes. So it's almost it becomes end to end. But of course, I mean, there might be challenges wherein some human involvement might be involved because of the kind of data involved, especially OCR, where accuracy is not 100%. So there are processes called as human in the loop, wherein 80% of processing is done automated through bots, and 20% is where humans have to just see to ensure quality control. And then so that is the usual methodology that you can follow.
Thank you very much. Thank you, Sandeep ji and Shailaja ji. It was very, very useful, and at short notice I could able to log in, and a few of my colleagues also joined. Thank you so much. Very much. It was very, very useful.
Thanks, Manjunath, for joining, and thanks everybody actually for joining. Yeah.
Thank you.
Thank you. So Sandeep, I mean, we all learned a lot thanks to you. So I think with this we sign off. Yeah.
Yeah. Thanks a lot. Thanks for the opportunity.
Thank you. Bye bye. Thanks everyone. Bye.